Good morning everyone. Today we are going to see the subject production planning and control and the unit introduction to production planning and control. The topic we are going to see today is break-even analysis. So it's a business analysis for confirming the production whether it is in profit or in loss by using some constraints like cost, operating profit, sales level, everything. The aim of break-even analysis is it going to help us to take a decision regarding make or buy. It help us to decide the product mix or promotion mix. It give you idea to give a expansion decisions or any alteration decisions for future plan. It also indicate the margin of safety. It also explore all the cost and revenue that is occurring in the production. And this chart gives an idea about where the break-even point in the total production. You see there is a diagram, there is chart like structure in the bottom of the slide that having two portions. One is profit, another one is loss. So this define where the profit start and where the losses begin. So for fixing the price for a product, selling price for the product, the manufacturer can consider all the fixed cost and variable cost and the level at which the loss going to begin. So by this diagram, we can come to a conclusion that over the point is the company going to attain more profit. Below that price fixation changes, we can attain the loss to the entire production. And coming to the benefits of break-even analysis, it gives an idea about smart price fixation and better decision making in the make or buy, and it figure out the missing expenses and it plan business funding at it set revenue and sales targets and it meeting the fixed cost. And coming to the assumptions considered in break-even analysis. First thing, the selling price will remain constant at all sales level. And there is no linear relationship between sales and volume cost. And it is assumed that the costs are classified into fixed cost and variable cost. There is no semi-variable cost. And it is considered that production is equal to the sales. That means there is no inventory in the arrangement and no other factors will influence the cost except the quantity. And coming to the formulas for doing the calculation of break-even analysis, there are some terms used in the formulas. First one is FC, fixed cost, VC, variable cost, and TVC, total variable cost, TC is the total cost, and TR is the total revenue, that is total income, and Q is the sales volume, that is quantity sold, and SP is the selling price per unit. And coming to the formulas, the first one is total cost, that is nothing but fixed cost plus variable cost, that is TC equal to FC plus VC into Q. The next one is total revenue, that is selling price per unit into quantity sold. And coming to the break-even point calculation, we have to go for one assumption, that is total cost should be equal to total revenue, that is TC equal to TR. Substitute corresponding equations and get QBEP equal to FC by SP minus VC. So this is nothing but in quantity wise, this is fixed cost divided by selling price per unit minus variable cost divided by unit. And coming to the break even point in terms of sales volume, that is in rupees, that is nothing but fixed cost divided by 1 minus VC by SP. And third equation is contribution, that is the difference between selling price to variable cost, that is C equal to SP minus VC. And contribution ratio is nothing but selling price minus variable cost divided by selling price. And the final formula is profit to volume ratio, that is nothing but contribution to the sales. And the next one is margin of safety, that is in percentage, the sales minus sales at BEP divided by sales into 100 is the formula. The limitations of break-even analysis is practically it is only for small scale level of operation, not for long range of operations, because we are neglecting the extra expenditure that is for per head calculations, depreciations, advertisement, everything not coming under price cost and variable cost. So we are consider only those two costs only, and practically selling price and variable cost per unit are not constant. And this is the example problem for finding the BEP. This is for a textile shop. They are producing a fixed, they are spending money for a fixed cost as 50,000, and they are selling their product for rupees 40. They are asking what is the BEP point, and they are given one example. Suppose the company going to produce 3,250 units, if it is profit or not. The calculation start from the BEP calculation. We know BEP is nothing but FC divided by SP minus VC. So we have to find the VC value. So VC is given in terms of selling price, 50% of selling price. Do the calculation, you find the VC as rupees 20 and substitute the VC in the BEP formula. We got 2500 units. Then second one is profit or loss when Q equal to 3250 units. There is a formula profit equal to total revenue minus total cost. Substitute every terms in the total revenue and total cost. Finally, we got rupees 15,000 as a profit. So that's all today. Thank you all.